Hi, I'm Pattu from FreeFinCal. In this video, let's look at the returns of the Sensex and compare it with the S&P 500 and the Nasdaq 100. Of course, we'll be using the INR variant of the S&P 500 and the Nasdaq 100. And I'm doing this because someone commented in one of my previous videos that the S&P 500 and the Nasdaq 100 they're guaranteed to beat the Sensex over the long term. Well, is that an opinion without data? That's very easy to find such things in the investing world, or is there any backing at least based on past performance? Of course, one could say that there need not be any past performance support, but we can assume that the tech giants that dominate the S&P 500 and the Nasdaq 100 today will continue to dominate forever, and therefore the chances of beating the Sensex is quite bright. Of course, when I say Sensex here, that also means the Nifty. Well, I mean, experience would tell us that most things in the market are cyclic. Alright, now I wanted to make a quick comment that some people may wonder, and some people are very likely to comment that it's not correct to compare the Sensex with the S&P 500 and the Nasdaq 100, the apples and oranges comparison, etc. and so on. Look, I'm not approaching this subject like a quant. I'm not doing research here. I'm looking at the subject like a lay investor would approach it. And for the lay investor, there's absolutely no problem in comparing the Sensex with the US equity index because both are equity, and the volatility levels, the drawdown levels, the risk levels, they're comparable. I cannot compare Sensex and PPF because you need both in the portfolio, because they're one is fixed income, one is equity. The risk levels are completely different. Here, both the entities are, all the three entities, Sensex, Nasdaq, S&P 500, all of them are equity. So there's no problem in comparing. And please recognize, nobody would want to invest in the S&P 500 and the Nasdaq if they were performing poorly. Nobody will say, no, I want geographic diversification, I want to invest in them. Nobody will say that. The only reason, I keep saying this, the only reason people are interested in the 500 and the 100 is because of their recent great performance. Nobody wants to invest in a loser. Everybody will say, I want that slice of that winning pie, and then they will call it, they only want a winner, but they will then call it as to justify it to other people, they will say it is international diversification. That is how the normal investor behavior works. I mean, we have to be very clear about this. So we should understand, what is this outperformance? Is it such a big outperformance? What has happened in the past? Now, this is the all the three indices. Maybe we should pull it out since March 1999, and of course, when I say returns here or movement index movement here, all of them is total returns index. We are not looking at tax because the taxation is different for the US indices. The dividend taxation is also different. Safely, we can assume that the returns from the S&P 500 and the Nasdaq 100 would be whatever return is shown for the total returns index, you can remove about 10% from that because of taxation. So from since March 1999, that's when the data is available for all the three, the Sensex has comfortably outperformed the other two indices. Of course, this is just one data point. We need to look at rolling returns. Now, let's do that. So this is the 5-year data, and you can see the pink is the Sensex, the brown is the S&P 500, the yellow is the Nasdaq 100, and you can see that this is the reason why people are interested in international diversification. You can see that in the last since 2012 or so, the Sensex and the the Nasdaq and the S&P 500 have kind of outperformed over 5 years the pink line, which is the Sensex. And this is even more clear over 10-year periods. Over the 10-year periods, you can see the pink line has been moving down. The other two lines, the other two US lines have been moving up, and that's the interest. That's why there's an interest. The point is, people who are here believe that this is the only trend that will be seen in the future. Nobody wants to believe that this is possible in future. I mean, everything is cyclic, this can happen, but they don't want to believe that. And if you tell them, they'll say you're silly. So again, over 15 years, you can see the Nasdaq has bet over 15 years only since the last 3 years or 4 years or so. And over 20 years, the Sensex has still kind of managed to beat the indices. Of course, excuse me, nobody knows what trend will persist in the future. You can see here, even over 20 years, there is a cyclic behavior in the S&P 500. Nasdaq is too young. The S&P 500 is pretty old, and you can see it's falling down and then it's moving up. So you can see a crest, a trough, and then it's moving up. Then there will be future crests and troughs. There can be, nobody knows what happens in the future. But the only point I want to make is, if I want to ask myself, is there a reasonable chance Sensex alone will be able to provide me with a return, overall portfolio return after tax above inflation, above the inflation that I actually face? Then the answer is there is a reasonable chance it will. And from that point of view, there's no need to clutter my portfolio up with international diversification. I've already mentioned this because nobody understands how to, they all want returns. Nobody understands how to quantify the diversification. So, so that's about that. And I've also, so this is, and you can see this, this may be of a little more interest. Now, in terms of quantifying this diversification benefit, now people will talk about correlation over days, weeks, and so on. I hate correlation coefficients. That's not intuitive to me. So what I've done is looked at the 1 year rolling returns, and you can see that the Sensex is in black, the S&P 500 is in red, and you can see that the upside potential and the downside potential both are linked of the Sensex is a lot more than the S&P 500. And if you consider 70% of S&P, 70% of the Sensex and 30% of the S&P, that's the gray line. And because you have 70% of the Sensex, the gray line mimics more the black line than the red line, and that's natural. And very few people will have 30% international equity in the portfolio. They will say 5%, 10%. This is that, this tukda thing, everything. You see something shiny, you add a little bit in your, this is like, you make all your grocery purchases and you want to go, you go to the billing counter and you see something shiny, you see a lollipop, you see a pack of condoms, you see a pack of battery, and then you pick it up and then put it up all. So that's how people diversify their portfolio, or diversify, whatever you want to call it. So I mean, it's not, there's not really much benefit in adding a little bit. That's my point. Of course, here I have not taken fixed income into account, so that's one thing that has to be taken into account. The similar graph for the case of the Nasdaq now is shown in blue. The Nasdaq has got a little more upside potential and downside potential compared to the S&P 500. So you get a little bit more benefit by adding Nasdaq. But I have strongly maintained that the Nasdaq is too concentrated. It's too volatile. It's just not worth it. I mean, it's anyway. Young people will never listen to that. So that's about that. I mean, there's really no evidence that the Sensex will has always performed badly in the past, and I don't think we can be so confident that the tech giants will continue to dominate so much that they will continue to outperform the Sensex forever in future. I think trends are cyclic. Sometimes Sensex will outperform, sometimes the US indices will outperform. But in terms of and one more thing, in terms of actual correlation over 1 year, you can see there are some situations where the red line is up when the black line is down. Some situations when both of them are moved up and down together. So the correlation is also not perfect. You cannot, and please recognize, when you have truly global financial crisis like what happened in the pandemic, what happened in 2008, every market will crash. How they recover, that's, you can't predict that. I mean, in hindsight, you know that the Sensex has recovered, well, but it is not, its recovery is not as much as the S&P 500, relatively speaking. and but that's just for this event. Future events may be different, so nobody knows. I am not trying to say don't invest in international equity. I am trying to say if you invest in international equity, you have to appreciate the responsibility. You have to pay more tax, you have to rebalance regularly. If you don't do that, then you can't say your portfolio is diversified. It is not.